October 10th, 2023, right here in Lagos, Nigeria. Good morning, good evening, wherever in the world you're watching from. It's Business Morning live from Channels HQ right here in Lagos. We have a packed show for you this morning. But first, let's take a look at some news now. We see the Central Bank of Nigeria has affirmed that the introduction of the e-Naira does not pose a threat to the country's financial stability. The CBN countered claims suggesting that the e-Naira could jeopardize financial inclusion, asserting that its central bank digital currency is both secure and instrumental in expanding financial accessibility. Issa Abdulmuin, the Director of Corporate Communications at CBN, addressed concerns of unsafe digital currency and clarified that some misinterpretations had arisen due to a lack of understanding of certain sections of the recently released Economics of Digital Currencies, a book of readings. And to the oil market, now we see global oil market prices edged down slightly today after gaining more than 4% in the previous session. That was yesterday. Brent crude fell 18 cents to $87.97 a barrel, while US WTI crude eased 16 cents, about 0.2% down to $86.22 a barrel. Both benchmarks had gained more than $3.50 on Monday on the news of conflict after falling steeply in volatile trading that was last week. We'll keep tracking what's driving sentiment in the market there. And back here, as part of gains of the deregulation of the downstream sector, Nigeria is set to become a net exporter of petroleum products by 2024. That's according to the Nigerian National Petroleum Company Limited, NNPCL. The company's Group Chief Executive Officer, Mr. Mele Kyari, stated this at the second edition of the Energy and Labor Summit, organized by the Petroleum and Natural Gas Senior Staff Association of Nigeria, PENGASSN. However, the president of PENGASSN, Mr. Festus Asifo, is lamenting the economic impact of the subsidy removal on Nigerians, especially the low-income earners. Take a listen.
NNPC Limited.
It's the second edition of the Energy and Labor Summit organized by the Petroleum and Natural Gas Senior Staff Association of Nigeria, PENGASSN.
One more time.
The keynote speaker is the Group Chief Executive Officer of the Nigerian National Petroleum Company Limited, Mr. Mele Kyari. He opens the conversation by dwelling on the gains of the Petroleum Industry Act.
There are today over close to 25 licenses to create refineries. Build and operate refineries. Nobody could take the next step because as long as you do not have certainty around pricing and who is going to pay for that difference, no one will put his money.
This opens the door to the conversations that followed, especially on the removal of fuel subsidy.
We had inadequate supply and dubious distribution of petroleum products, corruption, monopolistic practices, misappropriation, bunkering, trafficking of refined products to other countries.
As we stand at the crossroads of energy transition and calls for greener sources of energy, it is imperative that we come together to chart a new course in view of the fact that the deregulation of the petroleum industry and promotion of gas utilization are not merely policy changes.
However, the labor unions have suggestions on how to cushion the impacts of subsidy removal.
Recent policy direction by the government has placed untold hardship on Nigerians, chief of which is the PMS subsidy removal and the floating of the Naira-dollar exchange rate. The overwhelming impact of these on Nigerians can only be imagined rather than experienced. Part of the decisions of floating has only benefited the government and oil and gas companies in Nigeria.
The organized labor in Nigeria is less than 10% of generality of Nigerians who are working. So we need to also factor in the other Nigerians and their benefit. The way they can benefit, it has to do with transportation. Then the second aspect is that we also need to look at the other parts of life, what I would call the soft aspect of it, healthcare, education.
The ideas and strategies developed at this annual summit is expected to be shared with players in the industry to address the critical issues in the nation's oil and gas sector.
Well, we still have our team at Marrakesh for the IMF World Bank annual meeting. They've been giving us blow-by-blow reports of proceedings at Marrakesh. And our correspondent, John McCoy, had an exclusive interview with Patricia Scotland, Commonwealth Secretary General. Take a listen.
Thank you so much, madam, for sharing this time with us at the meeting. Could you share with us, in preparation for this meeting, you've attended a couple of meetings so far here in Morocco. What are some of your expectations? What do you see at the end of all of this meeting?
Well, I think one of the huge issues we're all going to be exercised by is how do we respond effectively to the challenge of climate change and the exogenous shocks which we have all been subject to in the last couple of years. If you think about the impact of COVID and then the Ukraine-Russia crisis, and now we see there are more difficulties happening in the Middle East. But what's our response to that? Because we have the Bretton Woods structure, which may have been fit for the purpose in 1945, but needs radical reform if it's going to rise to the challenges that we now face in 2023 and going towards 2030. So we are going to be talking about the need for reform of the international financial institutions, the issues in relation to the vulnerability index. You know that the UN have the multi-dimensional vulnerability index, which came out of the Commonwealth's universal vulnerability index, really created because the days when GDP could be the sole arbiter of whether you got concessional financing, it's really gone, because it doesn't bear with the reality of the lived experience of many of our member states. You know that the Commonwealth has 56 member states, but 25 of them are small island developing states. We have 33 small states, 14 of the least developed states, and many of the developing states in Africa, Asia, the Caribbean, and the Pacific are within our family. So their needs are complex, and they have been deleteriously affected by a number of these exogenous shocks. So these are the issues which are really at the forefront of our minds, and we've got to come up with a response to loss and damage. We made that commitment in Sharm el-Sheikh, but now what does it mean? What's the formula? What are we going to do with it? How are we going to make it work? And we're looking at new instruments. You know, if we're going to manage the debt, because many of our countries are either drowning because of sea level rise, or they're drowning in debt. And some of them are drowning in both at the same time. So I think there's a lot of anxiety, there's a lot of worry, but there's also a lot of hope, because I think we need dynamic, innovative, new ways of responding to these complex challenges.
You talked a lot about the smaller countries in the Commonwealth, especially, and also the issue of climate funding. A lot of these countries have been expecting the promised funding for some years now. It seems not coming in as soon as they thought. And then on the other hand, you have bigger countries like the UK. So they seem to be slowing down on the implementation of promised climate change actions and, reducing emissions.
Well, I think it's a really difficult time right now. And you're absolutely right. Way back in 2009, the world decided that they would commit $100 billion for climate adaptation mitigation for those developing countries who have been disadvantaged by the awful high increase in climatic disasters. And that just hasn't been honoured yet. So there is a big drive to say that 100 billion has to be given annually, but also we know that if we are going to reach globally the targets we have set ourselves by 2030, we're going to need 4 trillion. So 100 million is a step in the right direction, but we know it's not enough. And it's not enough, and it cannot only be done by governments. So we know that there has to be a public-private partnership. We know that we've got to be more vigorous when we come to looking at debt, but we also know that the old approach, which says that the only arbiter for whether you should get funding or not is fiscal rectitude. There was this wonderful idea that if you just employed fiscal rectitude, you would be able to develop an economy which would feed your people, be able to educate them, be able to create the infrastructure. We know that's not true because these exogenous shocks, so for example, if your country is hit by a Category 5 hurricane and you lose 226% of your GDP, go tell the hurricane that you were fiscally rectitude and that therefore it shouldn't have hit you. So these realities are really here now. The existential threat that the Commonwealth talked about in 1989 at the Langkawi Conference in Malaysia, where the Commonwealth family first identified this threat, is no longer a threat. It's here now. And we're feeling it. If we look at where we sit today, we're in Marrakesh. Thousands of people were affected by the disaster that was just a few weeks ago. And this is the new reality. And we think we have to come together and we have to find the financial instruments which will enable us to cope and cope better than we're coping right now. And those who have not been responsible for creating this climatic crisis, I think, have the least contribution to make, but they're actually making the greatest because they're the ones who are suffering on the front line.
Well, sounds like you're describing Africa right there. So when we look at the situation of Africa, the funding hasn't come, and yet these countries are feeling the impacts of climate change. What should Africa be doing at this time?
Well, I think President William Ruto really had the clarion call when at the Africa Climate Summit, the first Africa Climate Summit, he said, this is not an either war. This should be a win-win. We're all in this together, the global north and the global south. That we have to innovate, we have to change, we have to jointly think about how we can change this. But, you know, he was talking about whether we should introduce a carbon tax, talking about the fact that Africa is the cradle of humanity and Africa could very likely be the element which could create the innovation, the creativity to solve some of these problems. And we know that innovation is going to be fundamentally important. So Africa has to deal with the problem that she has found herself in, but which she has not created. And that response means that she has to use all her ingenuity. And the ingenuity that has been shown in Africa is absolutely phenomenal. Look at what people are doing in terms of taking advantage of green and blue economy, green and blue energy. And these new opportunities are real. I think Kenya has about, 97% of her energy is green. I mean, she's leading the way and others are wanting to follow her. But there's a whole way that we can restructure. We're looking at debt swaps for nature, nature-based solutions, creating a regenerative model of development, which will take into account the changes that we need. You know what the Commonwealth has been doing in terms of creating a blue charter, a living lands charter, using common sensing, which is the program we've called. But what that uses geospatial data in order to enable us to better understand and better deliver the sort of innovative changes we need. We've got the connectivity agenda, which is trying to bring us to the point where we will be able to do more. So all of these things are important. We've created a climate finance access hub to help our countries to get the money that they need by putting a climate finance advisor in countries. We've now got 19 of them. And we've trained more than 2,500 climate advisors across the Commonwealth to try and get the finance. I think it was the minister from South Africa who said, when we're talking about climate, we have not to be ashamed or run away from the F word. But the F word was finance. Because that's what we need. We need the money. And that's what Africa needs to do. That's what we all need to do. We need to work in partnership, come together, and we need to be the change we want to see. And it's not going to happen unless we make it happen.
And earlier in this conversation, you describe, the flood, both that of natural flood and that of debt. And it's not for just a few countries in Africa. What do you see as a way out of this huge debt and the request for debt restructuring?
I do. We've created in the Commonwealth Secretariat a new debt management system called Meridian, which not only seeks to manage the public debt, but also seeks to manage private debt as well. About 40 countries are using that, and 36 of those countries are our Commonwealth countries. So we've got to improve debt transparency. We also have to look at the level of interest that our member states are paying on that debt. The least developed countries are paying 3 times as much in debt interest rates than others, although they borrow half as much. The fact that many of our countries are spending more on debt interest than we are receiving on overseas development aid. So there has to be a recalibration of how that is done. There has to be fairness. We've been talking about climate justice, but we also need to look at debt justice, because you'll know that there's a direct correlation between the level of debt and indebtedness many of our countries have and the level of disasters to which they have been subject. And those disasters were not of their making. So this idea that we have to recalibrate, we've got to look at the Universal Vulnerability Index, we've got to understand vulnerability, we've got to understand what we need to do in order to enhance this opportunity for concessional funding. But this is not because people are looking for favours or handouts. All of the countries I have spoken to are determined to help themselves, but they do need a little headspace to enable them to do that. And whilst they are having to pay disproportionately more in interest rates than their brothers and sisters from the global north, they're never going to be able to catch up. So we have to look at what fairness means and to calibrate more accurately if we're talking about responsibility and culpability for indebtedness. Where did that debt come from? And that's why we were talking earlier about this whole idea of fiscal rectitude. Most of our countries were incredibly prudent and very careful and paid back their debt. That didn't mean they got cheap loans, concessional funding. It didn't mean that they got debt forgiveness. So I think we do have to look again. A number of our countries have been using, as I mentioned earlier, debt for nature swaps. It's not saying I won't pay, but let me pay for the things that's going to save my country from drowning. Let me pay for the things that are going to educate my children, enable my families to be healthy by getting the right medical care, helping me to build a better infrastructure for my country so I can grow my own wealth. So these issues are at the forefront of our discussions now, and we need solutions, and we need solutions which have a human face and bear some reality to the lived experience of the people of the world. And I think what COVID taught us, I hope, was that we will never be safe until others are safe, and we will never be rich whilst others remain desperately poor.
Well, there's this notion that most African countries are in debt today, in spite of the resources, natural resources, which have remained untapped. And it's all because of corruption and mismanagement of resources. What are your thoughts on this?
I think what you have to do is to be brutally honest about the nature of corruption and the nature of the anti-corruption measures that we've made. If you look at corruption, you look at the money the world has and the money the world needs to fulfill the Sustainable Development Goals. The difference between those figures is the sum equivalent to that which has been siphoned off. And then you have to ask another question. If, which is not admitted, there is corruption in certain regions, where does the money flow to, and where does the money flow from? So I think if we are being honest and fair, we have to accept it's a global problem which needs a global solution. And fiscal management does not protect you from crises which are exogenous shocks out with your control. So none of our countries could have predicted, nor were they responsible for COVID. Yet COVID has had a deleterious impact on all of our economies. None of us could control, certainly those in the global south, climate change, because climate change in the main is man-made and made out with the countries who are most disadvantaged by it. So I think it's complex, but it would be far too simplistic to say this is down to one aberrant consequence. It isn't. But I think everybody has to step up and accept that there's a multiplicity of causes to this, and we need a multifaceted response.
And that was an exclusive interview with Patricia Scotland, Commonwealth Secretary General, and that was our correspondent, Ini John Mekwa, right there in Marrakesh, handling that interview. So we'll take a break now. When we come back, commodities market update is next. Stay with us. Still a lot of volatility in the commodities market with the Israel-Hamas conflict still weighing on markets. Let's talk to Dumebi Oluwole now, senior analyst, financial derivatives company, joining me right here in the studio. Great to have you, Dumebi. So it's all about, this conflict right now. We're seeing commodities, all the markets are reacting, definitely at this time. How are traders, trading this conflict right now?
I mean, they're definitely pricing it negatively, and we're seeing all prices rising. What is happening with traders is they're pricing in a geopolitical risk happening, and that's simply because of all the key oil-producing countries that are likely to be involved or affected one way or the other with this conflict between Israel and Hamas. So that's exactly what's happening. We have countries like Iran, Iraq, Saudi Arabia, Egypt, potentially, being affected or involved one way or the other by this conflict and this tension. So essentially, it's not really a matter of whether oil supply would really be affected. It's just an issue of the tensions brewing in the Middle East and how that would potentially start affecting oil prices going forward. So it's more of like a prelude to what investors and what market traders think will likely happen due to these tensions. For instance, Iraq alone is the second oil-producing country after Saudi Arabia in OPEC. Iran as well is one of the top oil-producing countries within the Middle East region. Saudi Arabia itself. Egypt is the 27th, largest oil-producing country as well in the world. So there's a lot of things to focus on, a lot of things to be concerned about, and this is also happening amid OPEC's lingering OPEC Plus's lingering supply cuts on oil. This is happening with Russia and also happening with Saudi Arabia. And they've all indicated that this is probably going to happen till year end. And markets are also pricing that risk in. Initially, we had seen oil prices, retrace the steps backwards. And this is simply because the markets were pricing in a further rate hike by the US Fed and how that would slow global oil demand going forward. But right now, the tides have changed and markets are just focusing more on the Israel-Hamas conflict and how this would, feed into oil prices, and general oil market sentiment going forward.
Is this the catalyst that takes oil to $100 and above?
I mean, we've seen other things take it to $100 and above. When the Russia and Ukraine war initially started, we saw this happen. So there are chances that this could happen, and simply because before now, just based off of the lingering supply cuts from OPEC Plus, as Saudi Arabia and Russia, we had seen oil prices touch $96 per barrel. So now with this conflict arising, exacerbating already, existing tensions with supply, existing concerns with supply, oil prices could definitely, touch that $100 per barrel benchmark.
But do we still have a scenario where prices are not really affected that much, with this conflict?
With this, I mean, the chances of that is pretty much less than 50%, just simply because of the countries involved and how crucial they are to the oil market. Right now, the tensions or the risk being priced by market traders and even investors is not just on Israel and Hamas or even Iran or Iraq, but it goes beyond and goes as far as the entire Middle East region, simply because of how history has been often over time with Israel and Palestine tensions. We've seen Egypt get involved. We've seen the likes of Jordan get involved. We've seen the likes of Lebanon, get involved. We've also seen the likes of, the United Nations come into play as well. The US are also involved in tensions like this when it comes to Israel and Palestinian, conversations or conflict. So it goes beyond what is happening with both countries, but how other countries being involved in the mix will definitely either escalate or reduce the tension. So the market is closely watching what the US would likely do. The markets are also watching what the United Nations would say or do. The markets are also watching what would happen with Saudi Arabia and other oil-producing nations that are usually involved with this conflict, especially Iran and Iraq.
Right, and I guess risk managers right now globally are very busy,
Of course,
at this time.
Of course.
And I'm wondering, looking at Nigeria now, definitely we rely heavily on oil revenue. What's the impact you expected for the Nigerian economy?
So it's double-edged, just simply because higher oil prices should benefit our revenue position. I mean, it's a good thing when we're able to partake or benefit from higher global oil price and how that feeds into government revenue, both in dollar terms and even naira terms. An expectation would be that because oil prices are higher, if government is earning more, FAC disbursements to state governments would increase. So there's that bit, but there's also the part that right now the petrol markets are also deregulated, and even though there is the temporary subsidy happening with petrol prices. Expectation is that there might be an upward review just simply because oil prices are now higher. And if there's that upward review, petrol prices could increase further. Diesel prices are already trading at over 900 naira to a liter, almost about 1,000 naira in some filling stations, and we could see that also increase. And the offshoot of this is also an increase in gas prices, simply because most of the time, market sentiments that feed into global oil prices also feed into natural gas prices. And this is because most of the countries that produce crude oil are also high producers or big producers of natural gas, and this is because of associated gas that comes out with crude oil production during the extraction process. So all of this as well is also feeding into gas prices, global gas prices, and we could see that now filter into liquefied petroleum gas for consumers. This is cooking gas prices as well.
And we're seeing that gas prices, below that $3 level.
Yes.
Is this what propels it above it and maybe beyond?
I mean, most likely we've seen, and the reason why I keep saying most likely is just because we've seen how history over time with tensions like this have affected the global oil markets and gas markets as well. Still, a very recent reference would be when the Russia-Ukraine war initially started and how this affected, the global gas market as well and nudged up prices even almost to about $5 per I think it's MMBTU.
MMBTU,
yes. So we saw that happen, and this might just be something that would nudge global gas prices to about between $4 MMBTU to about $5, and definitely that would feed into our importation costs and also into domestic cooking gas prices.
Definitely, commodity traders are very busy at this time. Talk to
Yes.
me about the grains market. What's happening there?
I mean, grains markets are still being fueled by sentiments around the Black Sea deal with Russia and Ukraine. The issue now is, Russia is pulling back, or has pulled back from that deal, and was seeing grain prices actually fluctuate. Earlier in the month, I think that was in September, the food index, the FAO food index, we witnessed a decline in witnessed an increase in the cereals index. And this cereals index comprises of wheat, corn, and I think barley. So with that price increasing, we're clearly, seeing that these tensions are feeding into global wheat prices and that global grain prices, and that would also, feed into our domestic markets. One of the big things is how the increase in wheat prices or volatile wheat prices feeds into the price of wheat flour for Nigeria, and then we now also see an increase in the price of bread and other confectionery. So that's the value chain there. But the expectations are that with the harvest season for the US also coming up, and it's looking quite buoyant for grain prices, especially wheat and maize. This is by the report. Per the report of the USDA, and there are also reports that Canada's grain output would also increase, and as well as Argentina. So with all of these expectations, we could see prices stabilize to an extent, and but the pass-through effect between that and domestic flour prices or pasta prices or wheat prices might be a bit slow, simply because food prices are always sticky downwards. So once prices are up, the chances of them falling quickly is very, very low. So that's one of the things that I would likely see happen. That price stickiness just taking effect.
Consumers really hate that, because
Exactly.
prices just go up, boom,
and
coming down
is
always
very difficult.
Too slow, too slow. Thank you so much, Dumebi Oluwole, Senior Analyst, Financial Derivatives Company. Thank you.
Thank you for having me.
All right, take a moment now.
My kids are more than precious to me. Seeing them doing well and happy brings me so much.
And it's still about the Labour Party conference in the UK, take place in Liverpool, and we have our UK correspondent, Juliana Olayinka, right there. Great to have you, Juliana. Good morning. So we see yesterday the Shadow Chancellor, Rachel Reeves, set out plans to get Britain building again in order to revive the economy. Bring us up to speed on the Labour conference party so far.
Good morning, Laddie. Yes, that's absolutely right. It is party conference season in the United Kingdom, and this week is the turn of the Labour opposition party led by Sir Keir Starmer, who, according to every single poll you have a look at across this country, is the Prime Minister in waiting. Labour have been out of power for goodness, 12 to 13 years now, but because of all the scandal, including Partygate, Trustonomics, and now the fact that the Conservative Party are just so fractioned, it does appear that they could actually take the win at the next general election, which will be within a year. Now, within the next couple of hours, we are expecting a very major keynote speech by the Labour leader, but yesterday was the turn, as you said, for the Shadow Chancellor of the Exchequer, which is Rachel Reeves. Now, yesterday was a very important day because one of the ways that Rishi Sunak, the Prime Minister, is trying to deter the British public from voting for the Labour Party is by saying that you can't trust Labour with your money and they will bankrupt Britain. Now, just before she went on the stage, she had a rousing appraisal by the former Bank of England Governor Mark Carney, who was actually just the immediate predecessor of the current BOE Governor, Andrew Bailey. And he said, look, you know, whatever you've heard, whatever you've read, dismiss it, that Rachel Reeves is a serious economist and it's about time we put some of her policy into action. Now, that certainly would have hurt the feelings of Rishi Sunak because, of course, he was the former Chancellor before he became Prime Minister, and he has tried to kind of downplay her credentials. So she spoke a lot about it being tough. Of course, she referenced the cost of living crisis because we are still going through it, despite the fact that inflation has gone low. She didn't talk about tax-cutting measures, which we wouldn't really expect from a Labour government anyway. But, of course, people don't want to pay high taxes. Well, most people don't. Some other really important measures that it's worth mentioning is that she's going to be much tougher on Westminster expenses. And I think the whole COVID scandal, which is still in the courts, really did shine a light on just how much money is wasted through nepotism, through handing out dodgy contacts and fraud. So she said she's going to be cutting down on that she'll have a COVID commissioner to try and rake in the billions of dollars that was spent. And also she's going to be clamping down on the use of ministerial private jets. So a lot was focused on regulation with what she said. We didn't get much, but then, of course, they're the opposition. They're not in power. We know that, of course, once you're governing, it's very different from campaigning. So the Labour Party have been accused in the past of being policy light. So let's see if when Sir Keir Starmer steps on that stage in Liverpool, if he is able to convince the public that he does have a credible mandate and he can lead the country for the next 4 or 5 years.
Definitely we'll be tracking to get his comments later on. But according to a latest UK consumer card spending figure from Barclays, the amount spent on going out to restaurants plunged 10.8% month on month in September. Break this data down for us.
Yeah, that's interesting. I don't know if I'm able to say this word, considering the date. It's only October the 10th, but I'll say it. Christmas. Yes, Christmas. Yes. Christmas is way up there as a reason as to why consumers are not spending as much. This is according to official data from Barclaycard. They always track the actual spend of consumers across the UK. And you're absolutely right. They have shown that there has been near 11% dip in the amount of money consumers in the UK are spending on eating out, so that's dining at restaurants, and also getting in takeaways. And when surveyed, the top reason as to why people are saving money is because they want to save for Christmas. Yes, that is the reason why. In fact, 44% of those surveys said that is the reason. But then, of course, there are a multitude of reasons. We are going through a cost of living crisis. It is incredibly difficult to spend. And because of the narrative that's overshadowed media headlines, people are very worried. So they're cutting down on their journeys. They're cutting down on how much they're spending in grocery stores, and they're cutting down in retail. All the data supports that. So I think ahead of the GDP data that we're expecting on Friday, I think economists are quite worried that this recession that we're teetering on could actually become a reality.
All right, Juliana, thank you so much for that reminder. Now I need to start saving for Christmas. Thank you, Juliana. Always great having you on the show. Thank you.
Thank you.
All right, now let's take a look at what's happening with other markets now. The local bourse right here, bullish close there we got yesterday, almost 1%, and we see the bulls still starting off the week in bullish territory there, 0.97% for the all-share index, 67,101 points. Equity cap sitting at 36.865 trillion naira. We see there up 355%. The all-share index yesterday performance there, this started at 51,595, and now we're here at 29.6% year-to-date gains for the local bourse. Let's look at the activity there. We see volume, 268 million units of stocks there. It's down 28.18%. Value is 3.46 billion, also lower than what we had on Friday. Then we see deals 6,911, 911 there, up 1.30% compared to Friday's close. Banking counter though 0.44% down. There's the only red counter there. That was yesterday. Consumer goods counters in the green, up 0.78%. Industrial goods up 4.03%. Big move there. Industrial goods. So Boa Cement there topping the gainers chart. Oil and gas. That was finally not unchanged, 0.36%. Let's look at the gainers counter now. See at the top trades. Let's see who's topping the trades for yesterday. Fine, if I can get that slide. All right, okay, let's go to the fixed income market now. For the 21st July, June 2053 bond there, we see the value is 19.8 billion naira there, about 15 deals there, big demand there for the June 2053 for the FGN bonds. Total number of deals there, 22. Total value, 29.85. And the overnight lending closed flat at 1.7% as the system liquidity, we saw some liquidity issues there. Let's bring in Caleb Alimi now, Chief Dealer at Providence Bank. Great to have you, Caleb. Good morning.
Good morning, Ladi. Thanks for having me.
Fantastic. So we see bullish sentiment there at the T-bills market. Talk to me about what's driving sentiment.
Sentiments are largely driven by interbank liquidity. Market has been up for over a week now since the FAC inflows, the coupon payments, swap maturities have all contributed to liquidity in the system. So we're seeing, quite a number of, we're seeing a lot of Naira chasing some of the securities. As at yesterday, the market was up about 500 billion with very few securities to purchase. That's why we continue to see bullish sentiments there. There's an NTB auction tomorrow, and the size on offer is just under 50 billion, just about 40 billion or thereabouts in total. And you still have this much money chasing, those securities. We expect that there'll be a tightening in the rates from the last auction a fortnight ago. The one-year paper closed at 11.37. We expect to see about single digits, when the auction happens tomorrow, maybe around the 9-point-something handle. We should see that given the amount of liquidity chasing the securities. On the bond side, it's been bearish, really, but there's been also cherry picking of securities. You saw that demand for the 2053s. That's because that's the only paper yielding above 16%. So you have the PFAs, insurance companies, and others that have long-term interest going to pick up those yields. That's the highest yield we've gotten this year, and that's why demand remains on that part. But largely, the sentiment in the bonds market is negative, where you have bearish sentiments there. But in the T-bills market is bullish, driven largely by short-term cash play there by the banks.
So we're seeing a bearish movement there with the bonds market, but the T-bill is quite bullish. But generally, what are you expecting for tomorrow's treasury? How are you expecting investors? We're expecting some amount of oversubscription.
Well, there's going to be a huge oversubscription because the volume on offer is very small. I mentioned that the volume on offer is just a little under 50 billion, it's just about 46 billion or thereabouts. And then you have market is up over 500 billion. So investors will be crowding that out, and we expect the rates there to drop from 11.37 at the last auction to about single digits, under 10%.
All right, definitely be looking out for that. Thank you so much, Caleb Alimi, Chief Dealer, Providence Bank. Thank you.
Thank you for having me, Larry. Cheers.
All right, now let's head on to other markets now. Talking about the crypto market, we did see Bitcoin started a decent increase above $27,800 resistance zone, but failed to remain positive territory. And we see the sentiment in the market right now for traders and investors neutral, 50 points. They're not bullish, they're not bearish, they're just somewhere in the middle right there. Let's look at the top cryptocurrencies we track. Now we see Bitcoin, $27,653, down 0.91%. Ethereum, they're losing that $1,600 mark, down 2.59%. Big drop there. BNB, that's the native coin for the Binance exchange, $208, losing that $211 level, 1.64% down. And we see XRP also losing that 50 cent level, 3.11%. Big drop there. Top gainers, Tezos topping the counter there, 73 cents this morning, up 8.20%. So no double-digit gain for the top 100 coins that we track in the market. Let's bring in Element Damble now, financial market analyst. Hello, Element. Great to have you. Good morning.
Thanks for having me, Ladi.
Fantastic. So it's still about the conflict there, Israel-Hamas conflict. We see the oil and gold markets are both reacting. United States dollar is making fresh gains. I think it was down this morning, though. But investors are seeking shelter from the fallout now. But it looks like Bitcoin price action is not reflecting this geopolitical turmoil. Why?
Yeah, no, absolutely. I think what you're seeing now is traders moving to traditional safe haven. So whenever we see conflicts of the nature of what we're seeing currently, traders typically flee to the likes of gold. Of course, moving up to like $40 in the last 48 hours. We saw moves in crude oil as well. But Bitcoin, I know it has, and crypto in general has been seen as digital gold and things of that nature, but you are seeing investors go to the more traditional safe havens at present.
Right, and definitely we don't like wars, we don't like conflict, but is there a bullish scenario for Bitcoin with this conflict?
Generally, I think what you're looking at is, I think the opportunity does exist, but if you're looking at it from a more technical perspective, I think there's a few areas that Bitcoin first needs to pass. One of the main reasons why we see it on a technical basis trading a bit lower now, it failed to break out of a resistance recently of around 28,300. So I think it's going to test that level potentially later on this week. Of course, we have inflation data from the US. We have, of course, FOMC minutes tomorrow as well. So there's a few fundamentals which could push Bitcoin back towards that resistance. And I think if it does break that resistance and the situation potentially, and again, no one's hoping for that to be the case, but looking at the nature of markets, if markets start to react to any sort of escalation, you may see Bitcoin cross that threshold.
Right, we do hope for de-escalation going forward.
Absolutely.
But looking at the tail end of the year now, what are you expecting for Bitcoin's price action? What's the chart? What are the charts telling you that's going to happen by the end of this year?
Looking at it, to be honest, it does look like a lot of consolidation. I think the main area Bitcoin first needs to overcome, again, is that 32K level if you're looking at it on a more weekly basis. So I think the second it does pass that level, but again, now looking at the moving average, it does look like it is trending lower. So I wouldn't be surprised heading into November if we see Bitcoin potentially back towards 22K. So heading towards the end of the year, I think if it is able to finally break out of that 32 level, you could be looking at a strong start for the year. But for now, it does look like a lot of consolidation.
Fantastic. Thank you so much, Element Damble, financial market analyst. Always great having your perspective. Thank you.
Cheers. Thank you.
All right, so we see the top gainers there. We see Tesla's topping that counter. XDC, 4 cents. Up 0.28%. PAXG there, $1,868, and it's trading marginally up 0.08% this morning. Let's look at the top losers. Metaverse play there, Gala token there, 1 cent, down 7.04%. Woo Network is also on the losers count at 16 cents, down 6.42%. And we also see another metaverse play, that's Mana, the Decentraland, at 28 cents and down 5.76%. And ApeCoin there, also metaverse. So what's happening with the metaverse narrative in the crypto market? We're seeing a lot of profit taking, happening with that, with Gala there topping the counter. We also have Mana and ApeCoin. So that's how the market is looking today. Still neutral. Neutral is the direction and the sentiment in the market right now, talking about the crypto market. And that's the show today. Definitely we'll keep tracking to see how the conflict impacts markets going forward. And we'll drill down on that later on Business Incorporated. That's for 1:30. And if you want to get more updates and developments, just head on to our website, www.channelstv.com, and you can get more details, and you can also watch all the videos on our YouTube channel. Just flip over there and search for Channels Television. Thank you so much for watching. From me and the team right here at Channels HQ, it's bye for now.